Assalamualaikum warahmatullahi wabarakatuh. So today I'm gonna start with long-term financing, which is ordinary share. So if you wanna know, ordinary share is a method that increase the capital. Is one method to increase the capital. The company indicates the maximum number of shares that can be issued during incorporation of the company to potential investor who interested to become shareholder of company. Usually, every company upon registration put par value or nominal value of its share, which is they will decide usually at RM 1 ringgit or RM 50 cent per share based on the value of the share that was authorized. Next, uh, nevertheless, the performance of company will enhance the share price movement, which will become higher or lower than its par value. A company that usually has good financial performance will issue the share at higher price than its par value, which means that the share was issued at premium. Next, the company can also sell share at discount issue price below than par value but follow act under section 59(1) of the Company Act 1965, which the conditions state that the issues of the share discount is authorized by special resolution. The resolution specified the maximum rate of discount with share to be issued and the date of the issue not less than 1 year since the date on which company was entitled to commence business. Next, the characteristic of ordinary share. First is voting right. Voting right is shareholder is entitled to have right to vote for board of director, which is they can vote. Next, residual claim. Residual claim is a shareholder entitled to receive dividend every time company declare dividend on financial year. Next, right to information. The shareholder entitled to obtain information, every information including the audited. And lastly, the limited liability, which is shareholder do not have right to claim any amount that is still not enough pay off amount invested when company face bankruptcy. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. So today I would like to share with you guys what is preference share. It is a share entered at a different price. There can be voting, but they do have a limited liability to claim on asset and earning. So for the preference share, there's have a 6 types of preference share. First is cumulative, non-cumulative, participating, non-participating, redeemable, and lastly is convertible preference share. First is cumulative preference share. Cumulative preference share, the holder will get the fixed deposit fixed dividend every year, and if the company can afford to pay the dividend to the holder, they can bring forward to the next year. But for the non-cumulative, it will get a similar fixed dividend every year, but they cannot bring forward to the next year. So that's the kind of the different for both of that. For next is participating. Participating is same as the cumulative, which is they will get the fixed deposit, but for the participating they will get the additional amount from the another shareholder. So but they need to follow the article and association. So for the non-participating will get the fixed deposit, fixed dividend, but they are not allowed to receive any of additional additional amount from the other shareholder. So that's the difference for the both of that.
And next is a redeemable preference purchase. Can be repurchased from the shareholder at the future date as a predetermined at the time of issue of share. And lastly, for the convertible preference share, it can be converted to ordinary shares as per expert in the article and of association, but the company will fix the date and rate for every shares.
So that's all for the preference share. So thank you.
Assalamualaikum, my name is Nura Adira. So the topic is warrant. Warrant is a derivative instrument that gives its holder the right to buy a given quantity of the underlying shares at predetermined price on or before a particular date. Warrant are issued and guaranteed by the company. Until you exercise the right, you do not own the stock. Sometimes maybe issues attached to a right issues bond to make it more attractive. Either exercise your right to buy the company's share at the exercise price or sell the warrant in the open market. There is no accounting entries and memorandum of account will be maintained. There is two types of warrant, which is call warrant and put warrant. Call warrant is a specific number of shares that can be purchased from the issuer at a specific price on or before a certain date. Put warrant is a certain amount of equity that can be sold back to the issuer at a specific price on or before a stated date. Companies may issue a series of warrants whenever investor demand is insufficient. Each series may have different condition and price, allowing companies to promote a new, more favorable warrant over a previous series that is no longer appealing to the investor. This is example of warrant. So the term used in investing in warrant is exercise price. The exercise price is the price warrant holder paid to buy the company share. Conversion ratio is the number of warrants needed to buy one company share. Expiry date is the date the warrant will be expired. Gearing is indicate the level of leverage, and premium is indicate the difference between mother share price and warrant price if warrant is exercised. So that's all from me. Thank you.
Hi, my name is Nurul Filza. I'm going to explain topic 2.4, which is debt and borrowing, which means debt is berhutang dan borrowing ialah peminjaman. Untuk contoh, sebuah company furniture manufacturer, dia ingin membeli sebuah mesin yang mempunyai teknologi artificial intelligence secara hutang. Dengan ada mesin tersebut, terdapat penambahbaikan dari segi produktiviti dan kualiti yang dikeluarkan. Walaupun mesin itu dibeli secara hutang, income dan cash flow company tersebut semakin bertambah. Debenture. Debenture refers to any long-term debt which is unsecured by collateral or physical asset, yang bermaksud pinjaman yang tak secure. The main difference between debenture and share is for the characteristic of holder. Debenture known as debenture holder, while share as shareholder. For the ownership, debenture holder is a person who give credit in business transaction and cannot take part in the company's management. Yang bermaksud debenture ini adalah pihak yang memberikan duit, yang meminjamkan duit untuk menjalankan bisnes tersebut, manakala shareholder adalah owner of the company itu. Untuk the return, the debenture holder will get interest whether there is profit or loss and will be paid in all conditions, while shareholder will get dividend declared by the directors which is dependent on the company profits only. Maksudnya, walaupun company itu mengalami kerugian ataupun keuntungan, company tetap harus membayar kepada debenture tersebut. For the conversion of share, the debenture can be converted into share, but share cannot be converted into debentures. For the priority of claim, the debentures will get priority in case of liquidation of a company. And shareholder is the second priority because debenture, kalau apa pun syarikat itu nak bankrupt, syarikat itu perlulah melunaskan hutangnya, peminjamannya kepada debenture dahulu, baru settlekan terhadap shareholder punya hutang. Mortgage, there can be mortgage debenture. Contohnya, asset of the company can be mortgaged in favor of the debenture holder. But for the shareholder, asset of the company cannot be mortgaged in favor of shareholder. That's all. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Aina Shifa binti Amza. I'm from AS2473E. Today I want to present about lease. From that, you can see what is finance lease. Finance lease refers to the lease whereas the finance company owns the asset. Means that company have the asset and legally during the tenure of the lease, but all the risk and reward associated with the asset are transferred to the lease by the lessor, and at the end of the lease term, lease also gets the ownership of the asset. Now I want to show you what's the difference between operating lease and financial lease. Okay, for ownership, operating lease is with the lessor, and financial lease is transfer option at the end of the lease period is there with the leases. Okay, risk and reward are related to asset. For operating lease is with the lessor. For financial lease with the lessor. Okay. For risk and reward related to asset ni, operator lease and financial lease is the same. For purchase option, operating lease doesn't have any option, and financial lease have the lease have a purchase option. Okay. Expenses borne for operating lease is by lessor. Financial lease is by lessor. And then for the running cost to lease, operating lease no running or administration cost. But for financial lease have running costs and administration expenses and higher. Okay. And the for tax benefits to lease, no depreciation can be claimed. But for financial lease, interest and depreciation both claim. Okay. The reason company lease equipment: first, conserve capital. 2 is accelerated depreciation. 3 is.
Assalamualaikum warahmatullahi wabarakatuh. My name is Ahmad Imran. Today, I want to talk about the hire purchase. Hire purchase in Malay we call sewa beli. Hire purchase, which is HP financing, is one of the most common ways for people to buy private vehicles. For example, car. If you take on HP financing, you become the hirer, while the financier financing the vehicle is the owner. As the hirer, you will have to pay installments to the financier based on agreed duration, while you will have possession of the vehicles. When all installments are paid up, ownership is then transferred to you, the hirer. Under a hire purchase contract, the buyer is leasing the goods and does not obtain ownership until the full amount of the contract is paid. So, for more understanding, I will give one example. First, customer identify the vehicle to purchase, such as car. Then it will approach by the bank for financing and will purchase the vehicles, which is car. Next, it will rent to the customer. After that, the customer will pay the rent or monthly basis by agreement that agree by both sides. So that's it.
Assalamualaikum. My name is Muhammad Hazul Ikrar bin Salimat. So we move to the government assistance that consists of two subtopics, which is government grants and government loans. In general, a government assistance is the Malaysian government offers a variety of grants and funds to the development of Malaysian small medium enterprise under the agency. A government grant is given to an entity in return for past or future compliance with certain circumstances relating to its current activities. Partial grants are provided to support any business activities, which can be operational, management, or strategic nature. Operational business activities are entitled for funding, such as manufacturing goods, processes, and quality. Strategic businesses activities such as acquisition of cutting technology can receive government assistance such as supervision and financial help. Government grants is more focused towards industries. For example, information communication technology, green technology, and biotechnology. Essentially, government grants are divided into two levels, which are pre-seed and seed. Pre-seed refer to idea in mind and not knowing what to do. There are two programs under the level of pre-seed, which is Cradle Investment Program (CIP) and Multimedia Development Corporation (MDEC). For the government loans, Government of Malaysia offers a lot of financing program to help the small medium enterprise to start or expand their business in these few years. The effort of the government to encourage the rising of small medium enterprise can be seen from the improved and beneficial financing scheme year by year through national budget and also by comprehensive blueprint prepared by Economic Planning Units (EPU). There are currently 7 types of government loans open for applications such as Graduate Entrepreneur Fund, Graduate Entrepreneur Fund, Young Entrepreneur Fund, Fund for Small and Medium Industries, Halal Industry Fund, and so on. Thank you.
Okay, Assalamualaikum. My name is Muhammad Khairul Anas. Today I'm going to discuss about private finance initiative. The first one is in an effort to encourage greater involvement from the private sector to upgrade the handing over of infrastructure, facilities and public service, the Private Finance Initiative PFI program was introduced in the 9 Malaysia Plan in March 2006. PFI will be undertaken as part of the new methods of procurement under the Public-Private Partnership, which is PPP, to boost private sector participation in economic development. In Malaysia, PFI is interpreted as involving the handover of the responsibility of financial and running capital investment and services of public sector assets to the private sector, including the construction, management, maintenance, refurbishment and replacement of public sector assets in return for least just the equivalent with the standards, quality and timeliness of service provision, as well as an amount ample to secure returns on investment where the assets and facilities will be transferred to the public sector at the end of the concession period. The key purpose of PFI is to bring about closer partnership between public and private sectors so that better and more efficient public services can be provided to the nation. In addition, this infrastructure development is a major element to discover potential economic activities and support sustainable countries' economic growth. So that's all. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Firdaus bin Jabaluddin. Today I would like to talk about the main attribute of private finances initiative. Okay, the first point is the public and the private sector relationship is based on a partnership only. The second point is a specified output or outcome of a service pursued by a public sector for a concession period. The third point is private sector decided the needed input to gain the specified output. A private sector is given a latitude to present innovation into its design and development to decrease overall costs. Service payment is based on a predetermined standard and performance. Maintenance culture is fostered where the concessionaire with the responsible for the long-term maintenance of the asset throughout the operational tenure agreed upon. Integration of design, construction, finance, maintenance, and operation of total package. Transfer of asset at the end of a concession period becomes an option to the government. After that, optimal sharing of a risk is allocated to the party who is best able to run it. One of the example of PFI project in Malaysia is construction of 6 University Technology Mara campus, which are in Pasir Gudang, Johor, Jasin in Malacca, Seremban in Negeri Sembilan, and Samarahan, Sarawak, Puncak Alam, Selangor, and Tapah in Perak. That's all for me. Thank you.
Assalamualaikum. My name is Irsana Shaza bin Abdurrahman. So my topic is honest investment. Honest investment is actually a money which come from the owner's own savings. It may be the kind of startup fund that is used when the business is setting up, or in the kind of extra fund that is used for business growth. The benefit of this type of financing is it will not require any interest payment. The amount that an owner can invest may be limited since it might not be huge enough to finance the business totally. However, it is still one of the key contributors to the business capital. Any contribution from an owner counts. If an owner gives other assets like vehicle or equipment to the company, the owner's investment account will also increase. So for an example, take a startup lawn care business called Joe's Lawn for example. Joe has been mowing grass since he was 10 years old. Now he was graduating high school and ready to actually start a business. He registers his business with the state and contributes all of his lawn care equipment. This contribution credits his owner investment account and debits and the company equipment account. So for the conclusion is, owner's investment is the amount of assets that the owner puts into the company either to start it or to keep it running. Thank you.
Assalamualaikum, my name is Natra. So now I'm going to present the second source of internal financing, which is retained profits. Retained profit is another important source of internal financing. It is also known as retained earnings. Retained earnings is the sum that company keeps or saves for future use. It refers to the net income remaining after paying dividend to the shareholders or drawings by the owners of the capital. It is the portion of earnings that are retained in the company for the purpose of reinvestment in a business or reserved for a specific objective. It is a positive operating income from quarter to quarter. The company is generating the positive operating income from its successful business operations. It also refers to the residual net income or profit after tax, which is not distributed as dividends to the shareholders, but is reinvested in the business. Typically, the net profit earned by your business entity is either distributed as dividends to shareholders or is retained in the business for its growth and expansion. Retained earnings are calculated by adding net income or subtracting net losses from to the previous term's retained earnings and then subtracting any net dividends paid to the shareholders. The figure is calculated at the end of each accounting period, quarterly or annually. Retained earnings calculation derives the balance in the retained earnings account as of the end of a reporting period. This is the formula. So, retained earnings at the beginning of the accounting period added with net profit or net loss during an accounting period and then subtract dividends paid of both cash dividends and stock dividends. Furthermore, retained earnings are critical for any business as they help in meeting the fixed and working capital needs of the business, providing funds for growth and expansion, funding for new assets, paying off external loans, and withstanding economic downturn. That's all. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Saifuanadini binti Abdullah. So I'm going to talk about sale of stock or asset. It is a quick way of raising finance. By selling off stock, it reduces the cost associated with holding them. Business will have to take a reduced price for the stock. The money generated from selling the business asset normally is used internally for funding the company's project or other capital needs. Nonetheless, businesses do not always have extra non-current assets which they can sell off, and there is also a limit to availability of non-current assets which a firm can sell. So, the conclusion, in contrast, stock sale involves the selling and purchase of share of stock from the existing business shareholder. The buyer purchases the equity in the company assuming all assets and liabilities. Stock sales are not available in all types of transactions. Thank you.
Assalamualaikum, my name is Muhammad Fatih and my topic is debt collection. In debt collection, a business can raise finance by collecting the money owed to them from their debtors. Not all businesses have debtors, example those who deals only in cash. No additional cost in getting this finance. It is part of the business's normal operation. There is a risk that debts owed can go bad and not be repaid. Okay, now I will give an example of debt collection from my understanding. Example, I have rented a shop that costs 350 ringgit per month. The renting it will increase my finance. In the renting system also has its bad effects such as the renter paid the rent late or the renter disappeared and not paid a single penny. That's all from me. Thank you.
Okay, Assalamualaikum. Right now I'm going to talk about a short-term loan, which is basically from the short-term financing. So a short-term loan is basically a money that you borrowed of agreement of a agreement rate of an interest over a set of periods of time within the year. So the set repayment are spread over the period of time, which could assist of budgeting plan. Interest payment will make the loan basically more expensive. Normally the security may be required and by the bank for the loans. The estimation of cost of short-term credit, and the calculation actually is very easier if the period of the loans is 1 year period. So to determine the cost to the credit, the effective rate interest is basically used. So you can see over here is the effective interest rate, which is EIR, which is equals to the cost, which is basically interest plus fees divided by the amount that you get. So basically it's as for example, if you borrowed around 15,000 ringgit from a bank and it's stated the rate of 9%, and you must pay around 1,350 ringgit in interest at the end of the year. So your effective rate is the same as the stated rate, which is basically 1,350 divided by 15,000 ringgit, which is equals to 0.0.9, which is basically 9%. Thank you.
Okay, let's continue to trade credit. Trade credit is probably the easiest and most important source of short-term finance available to business. Trade credit means many things, but the simplest definition is an arrangement to buy goods and service on account without making immediate cash or check payments. Trade credit is a helpful tool for growing business, where favorable terms are agreed with a business supplier. This arrangement effectively puts less pressure on cash flow than immediate payment would make. This type of finance is helpful in reducing and managing the capital requirements of a business. The reverse situation also needs to be considered. This is where your customers or clients may request favorable trade credit terms. Put simply, any terms agreed with your customers or clients will reduce the benefit you have obtained through trade credit negotiation with your suppliers. For example, if you have agreed trade credit terms of 45 days with your suppliers and trade credit terms of 30 days with your customers or clients, the net benefit will be 15 days. It is the net amount that affects a business working capital, and a negative capital situation will need additional funding. When a business enters into a trade credit arrangement with its suppliers, a limit is usually set, commonly called credit terms. For example, you could set cash check or set cash, check or bank transfer payments to be made within 15 days from the date of the invoice, hopefully allowing you to still qualify for any early payment discount. If payments are not made within terms, all outstanding amounts are required to be settled within the normal time period set from the date of purchase. Credit terms will differ from business to business and industry to industry. Business that receive payments on delivery, for example, online shopping sites, may have a shorter credit term than an industrial manufacturer. In that case, projects are spread over a longer period of time, and payments may be received periodically on completion of certain pre-decided time slots. There are three main indirect costs of trade credit, as there is no direct cost involved. First, loss of yearly payment discount. Second, spoiling your relationship with your supplier if you do not adhere to the agreed trade credit terms. And last one, working capital cost if the net effect of receiving and providing trade credit puts your business in a negative working capital situation. So, for the advantage of trade credit, first, an agreement can be very easy to organize. Second, an agreement is relatively easy to maintain as long as the conditions are met. Then, it can be used by most business for suppliers of goods or services. Then, the further disadvantage, first, possible loss of yearly payment discount. Next is failure to comply with the conditions could lead to the loss of a supplier. Then, provision of cash flow advantage rather than additional finance. So that's all for trade credit. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Amir Faiz, and I'm going to explain about bank overdraft. A bank account overdraft happens when any individual's bank account balance goes down to below zero, resulting in a negative balance. It usually happens when there are no more funds in the account in question, but an outstanding transaction is processed through the account, leading to the account holder incurring a debt. This is where the business account is allowed to be overdrawn. These financing facilities could help to cover the period between money flowing out and flowing into a business. This is preferably used for a short-term period since it is cheaper than a bank loan. Bank draft interest is repayable on the amount overdrawn. This type of financing can be expensive to the business issues over a longer length of time. That's all for me. Thank you.